Good morning, friends. Welcome to Adda 24/7. We are in Achievers MCQ series for BFM, and today's topic is yield curves. Very important topic because yield curve is the base of any risk, basically currency risk. Okay, interest rate risk. So watch this video till the end. Firstly, download Adda 24/7 app on your mobile. In this app, you will be getting all the premium study material, current affairs, job alerts, daily quizzes, plus live classes, then ebooks, and then tests. Okay. So what all you need for JAIIB and CAIIB, you will definitely get it over here. Also, subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting all the updates for JAIIB, CAIIB, and various banking exams, and free YouTube series like the one which you are right now watching. Okay, so watch this video, very informative. Okay, this is the batch starting from February 10th. I would suggest everyone should join who's giving CAIIB, because portion has changed. You will be needing a mentor. More on this later. We will be covering here all the 4 subjects. Okay, ABM, BFM, ABFM, and BRBL, numericals, objective questions, case studies, everything. Okay, use the code Y432. Never forget this code. Let's start. Okay, yesterday I had asked you a question for the homework. The question was the significance of contingent liabilities. Means significance means what is the importance? It adds to the revenue generation of the bank. Bank may also have contingent receivables. Bank is obliged to meet the commitment only on account of failure to meet the obligation by the person on whose behalf the bank has given the commitment. So what was the answer over here? Say this. Contingent liability, importance of that. Revenue generation, yes, definitely. Means if I issue some LC to somebody or guarantee to somebody, definitely I'll earn the fee income in that. Okay. Banks can have contingency receivables also. Of course, this can also happen. And bank is obliged to meet only when that person doesn't perform. Means what? Suppose if I give a guarantee on behalf of I am the bank. Okay. I am the bank and this is the person, customer X. So if I give a guarantee on behalf of this customer to, let's say, state government. Okay, state government. Now if this person doesn't perform, only then I'll be required to pay. Okay, because this guarantee comes on the failure of this person to perform. Okay, so first job is this person and second job is mine. Okay, so that's why C is also correct. The correct answer is all of these. Okay, yeah. Now today's topic is yield curve. Yield curve means what? Firstly, you understand the basics of yield curve. Okay, yield curve is always plotted to yield versus maturity. Now what is yield? Firstly, you need to understand yield also. Yield means what? Yield is always, remember, required rate. Required yield equals to required returns. Required returns. Okay, always remember required returns. How it is calculated? Yield is calculated very simple. Coupon amount. Coupon amount. Coupon means the interest which I am getting, amount upon price of that bond. Okay, price. So that is yield. What is YTM? If I keep the same bond till the maturity, the average returns which I will be getting from the date which I will be purchasing to the date of the maturity is called as YTM. Yield to maturity, right? That's a separate formula for this. Now gone with this theory, done. Now understand one important part. The yield means required return. It's not the actual return which I am getting. Now what do you mean by this? Here, keep the logic very simple. Suppose if I am investing for, let's say, 3 months in FD, okay, or I am investing for, let's say, 10 years in FD. Okay, which FD will have higher rate of interest? What do you say? 3 months or 10 years? Which FD should have higher rate of interest? You guys only tell me. Yeah. Type in the comment section. Yeah. 3 months or 10 years? Which one should have higher rate of interest? Means which one to which I should expect a higher rate of interest. Correct? Right? 10 years will have higher rate of interest. Why are you saying 10 years will have higher rate of interest? Because you are expecting that as I keep the funds longer with the bank, I need to get some extra returns, isn't it? That's the basic logic you are getting. That's the expectation. So if such thing happens, this is called as a normal yield curve. Means the country is growing properly. It means, understand. If I am having the yield curve or the yield percentage for shorter period lesser than, mean the percentage is less than the yield percentage for the longer period. Always remember, yield is what I am expecting now. Okay. So that is known as normal yield curve. Now second one which you get it in the exam is this yield inverted. Inverted means what? The expected return for 3 months. This is 3 months and this is 10 years. The expected return for 3 months is higher and the expected return for 10 years is lower. How can this happen? This can happen. This can happen if, imagine if our country is going into depression. Means now, right now we are, everyone amongst us in India is in the normal curve. Imagine there are certain, even in US, some 4-5 months back, it was going into inverted this curve. Okay, what does it mean? It meant that people were expecting lesser returns in the longer duration vis-a-vis the higher duration, higher returns in the shorter duration. So when such thing happens, when this it is negatively sloped, it means that the country will go into not an acceleration phase but a deceleration phase. Okay, depression phase. Okay, next one is this camel hump. Camel hump means what? Similar to that of the inverted. Camel hump means right now in the short period I will be growing, but in the longer duration I will go down. So that is called as camel hump. And last one, this is flat. Flat means what? For 3 months also same returns I will be getting, for 10 years also same returns I will be getting. It means my country won't grow at all. It won't go down, but it won't grow also. It will be flat. Okay, the growth rate will be flat for my this country as such. Okay. Now I'll show you one live. Okay, because that will give you a better picture, isn't it? Let's go live over here. Let's go to live. One sec. Yeah. Let me show you this Mint article. Okay. See this. In this Mint article, if you see the curve, look at this curve. This is from 1st August to 30th November. Okay, shorter period. See here, always these curves are plotted for shorter period. Okay. So from 1st August to 30th November. If you look at the treasury bills, what is this treasury bills? Look at this. Okay. See this T bills. Treasury bills in yield in percentage. For 3 months it was yellow and for 10 years it was growing up. So what does it mean? 6.44 was on 1st August. This was the expected rate for this 10 years bond, and for in the long means on 30th November it was 7.06 percentage. So what does it mean? This yield curve was going in the normal route. It's like it was a like normal route, means this normal distribution curve. And here 3 month treasury bill, this percentage was going from 6.13 to 6.12, means almost flat, right? So what does it mean? It means that for the longer duration, people are expecting good growth in the country, whereas for the shorter duration, people are not expecting any growth in the country. And you see, even if you look at this for this period, 1st August to 30th November, during this period, last year only, December 22, what was the growth percentage? The growth percentage was almost nil for all the countries. Why? Yeah, that's why this yield curve became flat, isn't it? So always remember, yield curve will give you the right picture of what the country will be, whether the country will be progressing, whether it will be growing at a higher rate or no. Okay. So let's go back to our slide now. Okay. One sec. Yeah. Okay, coming back now. Let's go back to the questions. Okay. The features of interest rate risk are, interest rate risk means what? Interest rate risk is same as that of the yield curve risk. Okay. Interest rate means yield. Okay. The features of the, you can say, yield risk are, it is an exposure of bank's financial condition to adverse movements in the interest rates. So if the interest rates go in the adverse movement, like we saw just now, 6.13 to 6.12, okay, means it is going down. So adverse movement. It has direct effect on the net interest margin. So that is also a point. If the interest rates go down, so definitely what will I do? As a bank, I'll have to reduce my rate of interest for loans and FDs both. So definitely that will affect my NIM. It may also affect the market value of the equity. Means it may affect the market value of the equity. Means my share value will go down. Generally it happens. Okay. Whenever there is a change in the interest rate, the equity value will always be affected. Okay. So what is the answer for this? It will be definitely all of these, isn't it? All of these. Next one, let me remove these options. Okay, because otherwise you'll get these options instead of answering, you'll get it directly live over here. Okay, let me remove it. Hold on. Yeah. So let's go to this question now. Now answer this question. What do you say in this case? Yeah. What is the second option over here? What is the yield curve risk? When two different instruments maturing at different time horizon for pricing and assets and liabilities, there may not be parallel movement in the interest rates in both the instruments. Just now we saw this, the 10 years and 3 months, right? Non-parallel movement in the yield curve may affect the net interest income and all of these. So just now what did we see? Shall I show you again? Okay, let's go live. Okay, so see this, just watch these options and now go back to this. Okay, one sec. Yeah, look at this. Okay, look at this. So what were the options given over there? What were the options? Yeah, everyone, what were the options? When two different instruments maturing at different time horizons for pricing assets and liabilities. Is it happening that way? Two different instruments, see this, different horizons. Okay, 10-year and 3 months. Got it? Second one, there may not be parallel movement in the interest rates in both the instruments. Definitely there is not a parallel movement. Are these two lines parallel? No, right? Third one, non-parallel movement in the yield curve may affect the net interest income. Definitely it will affect my net interest income, isn't it? So the correct option over here is, what is the correct option? Everyone, what is the correct option? The option is D, all of the above, right? Let's go to the next one. When upward sloping yield curve will appear. Okay, are you able to see this? Hold on. Let me go back to the questions. Yeah, this one. When upward sloping yield curve will appear. When will upward sloping yield curve appear? During the times of expansion, when the recession occurs, when during economic transition, when long-term interest rates are lower than the short-term interest rates. So what is the answer? Okay, A, B, C and D. Just now I showed you this upward right, that 10 years curve was upward over there, isn't it? So what is the answer for this? Everyone? Yeah, correct. The answer is, let's keep it simple. The answer is A, right? During the term of expansion, you will always see the upward moving curve, isn't it? Shall I show you again the curves? See this, these curves. This was the curve. See this upward one. Normal curve, this one. 3 months and 10 years. 10 years is higher. Okay. Yeah. Next one. Define a flat yield curve. Flat means, just now we saw that flat. Short-term bond interest rates equal to the long-term bond interest rates. A. B. Short-term bond interest rates are greater than the long-term bond interest rates. C. Long-term bond interest rates are greater than the short-term bond interest rates. And D. Small company stocks provide greater yields than large company stocks. So which is the correct answer? Very simple. Just now we saw this. Shall I show you again? See this flat. See this flat. Short-term bond means 3 months, this over here, and long-term bonds mean 10 years. So is someone greater over here? No. Everyone is flat, means equal, right? So short-term bond interest rates equal to long-term bond interest rates, right? A is the answer. Got it? Clear? Simple? Type yes in the comment section if you have understood it up till now. Type yes, everyone. Type yes in the comment section fast. Okay? Move on. Chalo, let's move on now. Move on to the next one. So what was this? Yield curve was, yeah, next one. Next one is this. How, one sec, let me go to this question. How do you define economic transition? Transition in economy from recession to expansion. Transition in economy from expansion to recession. None of the two answers are correct, and both the answers are correct. So let me mark this A, B, C, D. Okay, this is A, this is B, this is C, and this is D. So how do you define economic transition? Recession to expansion, expansion to recession. None of the above and all of the above, both D. Okay, so what is the answer over here? Correct. Answer is D, because transition means it can be from recession to expansion also, expansion to recession also. Both the ways it's called as transition only. Okay. Move on to the next one. Okay. Let me remove the options first. Otherwise, what happens? It becomes easy for you guys. Immediately watch this and then revert back. Okay. A yield curve that shows down sloped curve is what type of yield curve? Down slope means this one is what type of curve? Normal, flat, inverted. All the yield curves show down slope curve. So what is the option over here? A, let me mark this A, B, C, D. A, B, C and D. What is the option? Normal, flat, inverted, or all the yield curves? What is the option? Correct one. Yeah, answer is C, inverted, isn't it? Just now we saw it. Downward slope. Downward slope means over here. See this, inverted, right? In inverted, this is 3 months bonds are priced higher than the 10 years bonds, right? Interest rates are higher, not price actually. Price is always lower. Okay, got it? Next one. Yeah, let me go to this one. Hold on, let me bring in the options. Yeah, a yield curve that shows upward direction and which the long-term maturity bonds will have higher yield means it will show a high upward direction like this. Long-term maturity will have higher returns than the short-term maturity. So that is called as what? Normal yield curve, flat yield curve, inverted, and all of these. Yep. What is this? Normal, flat, inverted, or all? Everyone. Right? This one. It is, but obvious normal, isn't it? Got it? Simple one. Got it? Clear? Move on. Understood everyone? Type yes in the comment section if you have understood. Also type the answers. Normal yield curve. Have you got this A answer, everyone? What is the answer? A or flat? Correct? Now one for your homework. Which of the following statements is correct regarding the yield curve risk? We want correct one. Huh? Now this you try it at your home. I'll give the answers tomorrow. When the interest rates are floating, banks may price assets and liabilities on different instruments such as T-bills, call money rates, MIBOR, etc. A bank needs to evaluate the movement in the yield curves and impact of the curve on the portfolio value and income. If liability is raised through 91-day T-bills and used to fund the asset of 364 day, it would be a yield curve risk. And D is all of these. So this is what you have to search now. Check this option, check everything, all the options, check in your books, check in the videos, and then answer. Okay. Now before going, let me come to this portion. Okay, this exam which I was talking of. See this. This batch which is starting from February 10th. Do join this batch. Why? Because in this batch we will be covering all the ABM, BFM, ABFM and BRBL, all the 4 subjects. Numericals, objective questions, theories, case studies, everything is covered. Now how to use this code Y432? Because this is also important. Getting discounts is very important in life. Okay, so always try to get discounts. Okay, so let's go to Adda 24/7 live. Yeah, see here we are on Adda 24/7 over here. Once you come to the main page, just type Adda 24/7 on the website. If you are having the app, go through the app. In the app you will be getting 1% extra. Okay, click on JAIIB and CAIIB. Then you get on the front page you get all these things, right? So click on CAIIB 23. Once you click on CAIIB 23, you will see the batches. Click on this batch. English batch, first batch only. Okay, now look at the details. All the details are given. For example, details means what is the starting date, what are the timings, then how many days, then all the 4 subjects which are to be covered. So you can go on and reading the details. Okay, all the things which are required for CIB are covered. Now let me come to the fees part. 23,999. Okay, click on view offers, put the code Y432, Y432, click on apply. Now look at this, 77% off you are getting. 23,999 reduces to 5,519. Such a huge discount you are getting. So grab this opportunity ASAP. Even I would suggest you can go for Mahapack. In Mahapack you will be getting multiple batches. Let me show you. Okay, see here. Go again to the main page. Okay, JAIIB CIB Mahapack. Click on the Mahapack. Now see this. Once you click on this, you will get this CIB ka Mahapack. Click on CIB ka Mahapack. Okay, you will see the details. Details means, see this again, 15 plus batches for CIB. Complete all the 4 subjects, ABM, BFM, ABFM and BRBL. 15 plus batches. Okay, then case study classes separately, then 15 plus full length mock test, topic wise question banks. So you will get you go on and on, you get multiple things over here. Okay, now recorded videos are available definitely for all the batches, so you can definitely bank on that. Okay, now let's come to the fees part. 35,996, 15 plus batches and fees is 35,996. Now even this you will get it discounted. Click on view offers, put the code Y432, Y432, because the portion for CIB has changed. Okay, remember the new portion for CIB is having 4 compulsory subjects. Okay, not as the earlier one. Earlier we had only 2 compulsory subjects, right? ABM, BFM and retail was a elective, right? So now 4 compulsory subjects over here. See this, ABM, BFM, ABFM and BRBL. Okay, 4 compulsory. Then rural, HR, IT, central banking, risk, these are the electives. Negative marking has been removed. Okay, so that I'll cross it now. So that is a good sign for you. Okay, so that's why I would suggest join the batches, because portion is new, subjects are new. Okay, you'll have to study hard and you'll